Okay, so we have a question over here on consolidation, which is with the name of Premier. Okay. In this case, they have asked you if you can look up at the requirement of the question that to prepare the consolidated statement of financial position for the Premier Group as at of 30th September 2000. Now, you can see that they have provided you with the individual balance sheet for both the parent and the subsidiary. You have additional information. We will consider that, and with that basis, we are going to prepare a consolidated statement of financial position for the Premier Group. Now, for this, the first thing what you have to do is that you have to set out your workings. Okay. So, working number one would be to prepare the group structure, right? And when you're preparing the group structure, you need to see a couple of things. So let's start the question. It says on 1st of June 2000, right? You can see that once you read the date, you need to understand that uh, what is exactly the date of acquisition, like how before it is from the reporting date. So your reporting date is at 30th September 2000. So the acquisition has happened on June. So without reading the question further, first clear out the date in your mind. Okay. So that's from June to September. So that's going to be June, July, August, and September, like 4 months basically. Okay. So in this case, Premier acquired 80% of the equity share capital of Sanford. So the name of the parent is the Premier Company. Okay. The subsidiary is your Sanford. The date of acquisition, like you need to specify, right? So we will say the date of acquisition is 4 months before the reporting date, right? And the percentage of ownership, what we have is basically 80%. Okay. So that indicates that the NCI would be the other 20%, right? So once when you have prepared the group structure, now you can set things further. It says Premier acquired 80% of the equity share capital of Sanford. The consideration consisted of two elements. So the question is very straightforward over here that in order to purchase the Sanford company, Premier company had given the consideration into two forms. The first of them is a share exchange of 3 shares in Premier for every 5 acquired shares in Sanford and $800,000 cash, right? The share issue has not yet been recorded by the Premier. So obviously, when you're preparing the consolidated financial statements, the Premier company has issued their share capital, so we need to record that, right? What is only recorded is basically the cash consideration of 800,000. And if you look up over here, in the balance sheet, the parent has investments worth of 1.8 million. So I do understand from that 1.8 million, you need to break this thing up. 800,000 is your cash consideration, which you have paid in order to acquire the Sanford company. But the rest 1 million is basically your other investments, right? So while you're consolidating the individual balance sheet for the parent and subsidiary, that 800,000 will be cancelled, obviously, because that's the investment in the subsidiary and you're representing both the companies as a group. So you have to cancel the investment in subsidiary with the net asset acquired of the subsidiary company. But then there will be a balance of 1,800 over there. Oh, 1 million over there. Okay. From that 1.8 million, $800,000 is a cash investment in Sanford, which you have to cancel, and then there is a balance of 1 million which still be reflected in the consolidated financial statement, right? So Premier had at the date of acquisition, shares in Premier had a market value of $5 each. Below are the summarized draft financial statements of both the companies, right? So now like it's up to you that whether you can move towards working number two, or you can like working number two, as you know that it's for the net assets of Sanford company. Here you have it at uh, the 1st of June 2000. That's the acquisition date. And then you have it at 30th of September 2000. That's the reporting. Okay. So it's up to you that if you want to calculate the cost of investment, you can do it right now. But I would prefer that you just follow the set pattern of workings, and when the time will come to calculate the cost of investment, that's in working number three. When you're trying to find out the goodwill, I mean, you can do it at that time also. Okay. So, anyways, we will wait for working number three to use this information and find out the cost of investment. But for right now, what we are concerned is about your net assets, which is at the acquisition date and at the reporting date. Now, if you look up at the balance sheet for the subsidiary, it does has equity shares of $1 each, which is the nominal value, and then you have retained earning, which is 4,500. Okay, so I can just simply put my 1,000 sign, and I'm going to write down over here the share capital. Okay, so for the reporting date, it's just simply a copy paste exercise from here, which is going to be 5,000 for the share capital, and the retained earnings would be 4,500. Okay. So the share capital will not change from the date of acquisition to the reporting date. So that will remain at 5,000, but we need to calculate the retained earnings at the date of acquisition, which is on 1st of June 2000. Though we know that what's at the reporting date, that's 4,500 simply given in the balance sheet of the subsidiary company, but you need to figure it out over here for the retained earnings at the acquisition date. Okay. So now, if you look up at the adjustments over here, okay, uh, right, let's see what adjustments do we have. I'll just increase the size for this. Okay, so let's have a quick review on them. So see, this at the date of acquisition, the fair value of Sanford's asset were equal to their carrying amount, with the exception of its property. So basically, that's a fair value adjustment. Okay. This is basically sale of inventory. This is an intra-group balance of trade payable and receivable. This is something about the Premier's investments, which I already explained you that they do have investments worth of 1 million apart from the investment what they have done in the subsidiary. This is the policy for their NCI, which is to be recorded at fair value. So we have to record the whole goodwill like 100 percentage, not proportionate but fair value, in which we record 100 percentage worth of goodwill. There has been an impairment of goodwill by 1.5 million. So all of these points you just have to go through them while you're attempting the exam question, so that you exactly know that when to use which point basically. But here, if you see, Sanford's profit for the year ended 30th September was 3.9 million. Okay. So for the year, it was 3.9 million. So if I have to go, like, it's like 4 months back, right? So we are assuming that the profits will be accruing evenly over here. Okay. Like every month, you're just making exactly the same profit before acquisition and after acquisition, like post acquisition. So what we're going to do over here is that, see, uh, either you can take 4,500, okay, because that's the retained earning, which is at the reporting date. Okay. So it will have been increased by the profit which you have made in the 4 months, right? So if I delete that profit from that 4,500, I'm going to get my retained earnings, which were at the acquisition date. So basically, the difference between the acquisition date and the reporting date is 4 months. Now, that's the point that if you have made your group structure properly, you will be using that information again and again while you're attempting the question. So it's better that you prepare the group structure. Okay. So what we're going to do is that from that 4,500, we have to subtract 4 months profit, right? So that will be 4 divided by 12 into 3900, which is 3.9 million. So what you will get is the retained earnings at the acquisition date, which is going to be 3200. So in the next 4 months, like from June, July, August, and September, you have made a profit of 1.3 million. Okay. So now once we have got the retained earnings at the acquisition date, we can just simply add them, and we will be getting the net assets at the acquisition date, and this will become your net asset at the reporting date. After that, now we can figure out your fair value adjustments. Okay. Okay, so for the fair value adjustment, we have the first point which says that at the date of acquisition, the fair value of the subsidiary assets were equal to their carrying amounts with the exception of its property. So it's only one asset which is not at its fair value. This had a fair value of 1.2 million below its carrying amount. So now, see, it's not necessary that every time the fair value will be above the carrying value and you would have to increase the value of the net assets. Okay. So in this case, like you can see that there has been the fair value of that property is below the fair value is below the carrying amount, right? So we need to reduce the value of your net assets with the amount of 1.2 million. So as far as the fair value is concerned, you will have the fair value adjustment is concerned, you will have property in which you have to reduce its value by 1200. Okay. And likewise 1200 as in 1.2 million, and that will also be done at the reporting date. So once you have done the adjustment at the acquisition date, you also need to adjust that same amount at the reporting date. Now, the problem is that in case if you reduce the value of the asset actually, so the depreciation will also reduce, right? Normally what happens is that when you increase the value of the asset, then there's an extra depreciation. The extra depreciation reduces your net assets. But in this case, because the value of the asset is less, so there would be a lesser depreciation, which in fact will increase the value of your net assets. Okay. So we don't have extra excess depreciation. We have here the reduction in depreciation, which in turn will increase your net assets. Okay. So for that, what you have to do is, see, it's basically 1200. Okay, so I'm writing it positive because it will increase my net assets. The remaining life of this is 8 years, right? So you divide by 8, but then you do understand that the difference between the acquisition and the reporting date is only for 4 months. So you have to multiply, like prorated by 4 by 12. So that will give you around 50. So that 50 was the extra depreciation was charged by the subsidiary. Okay. That we need to remove because when you're consolidating, you have to bring the net asset at its fair value. Right. So that's all in this first adjustment. Now, you need to understand over here, that's the part of the format, that if there is any intra-group trading, like if the parent or the subsidiary is selling goods to one another, okay, you need to identify that who's the seller. In case if the subsidiary is the seller, the unrealized profit on that transaction would have to be adjusted from this working number two, where you're talking about your net assets. But in case if the seller is the parent, then you have to wait for working number five, which is going to be the group retained earnings, in order to adjust for the unrealized profit. Okay, so here you need to understand Premier had 2 million at cost to Premier of inventory that had been supplied in the post acquisition period by Sanford. So basically here, if you understand that the Sanford is actually the seller, so I need to work out for the unrealized profit while I'm doing working number two, because the subsidiary is the seller. So either the subsidiary is selling the assets or the subsidiary is selling inventory. In case if there is any unrealized profit, you need to adjust it in working number two. But in case if the parent would have been the seller, then I could have ignored this adjustment right now, and I would have just simply, total out my net asset for the acquisition and reporting date and wait for working number 5 to adjust for the unrealized profit. So here you have an unrealized profit, okay, because the subsidiary is the seller. Now, you see, Premier had 2 million worth of goods which were unsold, okay, post-acquisition period, and the Sanford makes a markup on cost of 25% on these sales. So when it's a markup, it's basically the selling price is above 100, right? So in that case, the selling price is 125%. The cost is 100 and the profit element is 25. So when you're talking about markup, you take cost as 100, you add up the profit markup, and then you get the selling price. So in this case, you don't need to figure out that what's the percentage of inventory which is unsold, because it's already given to you in the question that they have worth of 2 million goods at the reporting date unsold as at 30th September, right? So this unrealized profit would have to be adjusted only from the reporting date, because this transaction was not there at the acquisition date. It has happened during that 4 months, right? So it only needs to be adjusted from the reporting date. So in that case, 2 million is, this would be negative unrealized profit. It will reduce the net asset. So 2000, that's 2 million, right? And the markup would be 25 divided by 125, because 125 is actually the selling price and 2 million is also the selling price. The cost to Premier is actually the selling price what the subsidiary Sanford has charged to it. Okay. So in this case, the unrealized profit over here is 400. So you have to reduce that amount from the net assets, right? So far, I don't think that we have any other adjustment which we need to figure out over here, okay? Because this adjustment, trade payable and receivable, this is something which you will be using it while we are consolidating the individual balance sheets of both the parent and the subsidiary. This one relates to the Premier, because they're talking about Premier's investments, okay? So in that case, this will also be considered while we are working for the group retained earnings, and we're just talking about the parent. Right now, we're just talking about the subsidiary. So we don't need to use this adjustment. The point is that once with practice, you will actually understand that what point to read at what time, what information you have to look while you're doing the consolidation question. That's the thing with the practice. So in case if you're missing or skipping a point, it doesn't matter, because you at the end of the day know that where you have to look for what information. So we do know that NCI is at 3.5 million valuation. So that's also going to be used while we are calculating the goodwill. And once we calculate the goodwill, so there would be an impairment also, right? So now we can get up a total over here. So this will be 8,200 and minus 1,200. So I'm going to get 7,000, and the net assets at the, so that's 7 million over there. And the net asset at the reporting date will be 9,500. Then you have to subtract 1,200 for the fair value adjustment. You have to increase 50 for the reduction in depreciation. And then you also have to subtract for the unrealized profit. So that's going to be 7,950. Okay. So this 7 million will be part of the goodwill. This 7.95 million will be part for the NCI calculation, and the difference between them, which is 7,950 minus 7.95 million minus 7 million, you get 950,000, which you're going to be using it for your retained earnings. Okay. So here what we have is the basically post acquisition period. Anyways, so now we can move towards working number 3, where we have to find out your goodwill. First, we will find out the goodwill for that 80% on which you have the control. And for that, we need to find out the cost of investment. So now it's actually the time where we have to use the information which was given at the start of the question, that when you're talking about the cost of investment, you actually have two components over there. One of them is your cash, okay, which is going to be 800,000, and then you have the share consideration. So you can see that 80 percentage has been acquired of the total share capital of 5 million, right? So in this case, it will be 5 million into 80%, right? So that's like 4 million shares have been acquired, okay? And on every, they have given 3 shares in Premier for every 5 acquired. So on every 5, okay, you're going to divide by the number of shares which you have acquired in the subsidiary, and you're going to multiply it by the number of shares which the parent company is issuing. So on every 5, you are giving 3 of your own shares, and that also has a valuation of $5. Okay, so you need to multiply it by 5 so that you can get it into valuation. So that makes it to 12 million. So this gives me a total cost of investment at 12.8 million, right? Wait. So that's like 12.8 million. And then if you can deduct the share for your net assets, okay, you will get your goodwill as in the share of the premier's goodwill. So the net assets at the reporting date, as we calculated, is 7 million. So the share of the parent company is 80 percentage. So we can say less parent's share in net assets. That's going to be 7 million into 8%, 80 percentage. So that's 5,600. And we get the goodwill, which is allocated towards the parent at around 7,200 or 7.2 million. Likewise, we have to calculate the goodwill for the other 20 percentage, which is for the NCI. They have already provided you with the fair value of your NCI, which was given to you at point here, fifth number, 3.5 million. So this will become 3.5 million minus less NCI share in net assets, which is 20 percentage. Okay. So 20 percentage of 7 million, right? So that will give you 1400. So the goodwill which belongs to the NCI is 3.5 million minus 1.4 million. You get 2.1 million. So the total goodwill at the acquisition date would be 7.2 million for the parent and 2.1 million for the NCI. So that's 9.3 million. But as you know that there has been an impairments of 1.5 million in that 4-month period. So we need to reduce that, which is 1.5 million. And this will give us the goodwill at the reporting date. Okay. So in that case, it will become 9.3 million minus 1.5 million. So you're going to get around 7.8 million. Any problem with this? Right. So after this, once you have calculated the goodwill, we need to allocate the impairment between both of them. Okay. So this calls for an extra working over here, which is this part is your controlling and this part is the non-controlling part, right? So the goodwill, while for the controlling part was 7.2 million, and for the non-controlling part, it was 2.1 million, right? So all of them are in thousands. Now, as far as the impairment is concerned, see, it's like the total impairment of the goodwill, right? So some part belongs to the controlling part, which has to be recorded in the group retained earning. But then there's an other 20 percentage part which doesn't belongs to the group. It's for the NCI. So that you need to prorate it to NCI, right? So what out of that 1.5 million, 80 percentage belongs to the controlling part. So that's 1.2 worth of impairment, which is belonging to the controlling part. So In this case, the goodwill, which is for the controlling part after the impairment, is 6 million. And here, from 1.5 million, 20 percentage belongs to the NCI, so that will give you 300. And the NCI share of the goodwill will be 2.1 million minus 300,000. So that's going to be 1.8 million over there. So if you get an impairment, it's necessary to break it up into the parent, the controlling share and the NCI share, because both of them will be recorded separately. Okay. You will see it in working number 5 that what percentage of goodwill I record, goodwill impairment I record. Right. So once you have completed the working for goodwill, now we can move towards the next working, which is of the NCI. You can simply take the value of your net assets, and you can also take the value of the goodwill after the impairment, right? So as far as the net asset is concerned, it's quite simple. You already had the net assets of the subsidiary at the reporting date, which is 7.95 million. So what you simply have to do is you have to take that 7950 and you have to take 20 percentage of that. So that will be belonging to your NCI. So that's 1590. Goodwill after the impairment, you just simply have to take this figure, because you see, I mean, if I've set the workings correctly, later on it becomes quite easy for you, and you don't need to worry about. Okay, so it's better that you stick to the format, stick to the workings pattern, and things will automatically fall in its correct place. So 1800 would be over there. So the total value of the NCI will be 1590 plus 1.8 million. So that will give me a total of 3.39 million. That's the value for your NCI. So for NCI, it's 3390. For controlling interest goodwill, it's 6 million after the impairment. Here it's 1.8. The total was 7.8. So these are your total answers which you will be kind of needing it. Share consideration was at 12 million. So yeah, this 7 million we used for the value of goodwill. This 7950 we used the value for your NCI. This 950 I'll be using it right now for your retained earnings. Okay. So once when we have done with your working number 4, well, that's for the NCI, we'll move towards working number 5, which is your group retained earnings. Yeah. So now for that group retained earnings, we need to use the parent. For the parent, we have to take 100 percentage retained earnings, right? So for parent, it's about 12.3 million. Okay. For subsidiary, it's going to be the share in post-acquisition retained earnings. So that's going to be, as I told you, that we will be using 950 into 80 percentage. That's our share. So that's 760. So the total which comes up is 12.3 plus 760. So that turns it out to 13.06 million. But then you have to deduct share of goodwill impairment. Now, share of goodwill impairment is simply going to be your this one here, 1.2 million, because we have already prorated. So you just have to bring the figure down. So that's 1.2 million share of the goodwill impairment. Right. So now what's left is basically, if you see this point. So we have taken care about the profit for the year. We have taken care about the goodwill. We have taken care about the NCI valuation. We have taken about the care for your unrealized profit on your inventory. We have taken care about the fair value adjustments. Now only these two things are left. Okay. Now Premier's investments include investment in shares which at the date of acquisition were classified as fair value through OCI. Okay. So this has nothing to do with the retained earning. It's basically part of the OCI. Now, the point is like, I just wanted to make a clear indication over there for this point that, see, when you have investments in another company which give you control, you basically consolidate, okay? But in cases where you have an influence, you call it as your associate. But in cases where you don't have an influence and you don't have a control, they are just purely as your investments where IFRS 9 comes into action. Okay, so these investments can either be recorded at as a fair value through PNL or through fair value through OCI. So from this 1.8 million, 800,000 was in this subsidiary, but the other 1 million of investments are in those type of companies which is neither giving Premier their influence or neither giving the control. So they are just simple investments where you own less than 20 percentage, right? And the policy for that investment is to record it at fair value through OCI, and that's what they have given to you in the question over here. They say that investments have increased in value by 300,000. So that 1 million is now at 1.3 million. So it turns it out to 1.3 million. The other equity reserve relates to these investment and is based on their value as of this date. That's like 1 year before. Okay. That's not 2000. That's like 1999. There were no acquisition or disposals or of any of these investment during the year. So that actually means that the price of the investments have gone up by 300,000, and that's what it you have to account for, right? So it doesn't affect my working number five anyways. Okay. So that's it. We are done with our working number five. So that's going to be this plus, oh, sorry, minus the impairment share. So the group retained earnings turns out to be 11,860. But I'm going to work out over here for my OCE, other components of equity, right? Other equity reserve, which is you have a balance over there. Balance is at 500.5 million. Okay, 500,000. But then you have to increase it up, increase in fair value of investment. So that's going to be by 300. So this gives you a total of 800,000. Okay. Yep. So now I think we have done with our workings, right? Now it's time to prepare and consolidate both of them. Okay. So while you're doing the consolidation, you have to write down the name of the group, which is the Premier Group. You have to write down the statement, what you're preparing, which is consolidated statement of financial position. And the period, which is as at 30th September 2000, right? Okay, so we put the dollar sign over here. The first thing what we have to write down is your assets, and the first asset which you have is your property, plant, and equipment. Okay, so for property, plant, and equipment, what you have to do is you have to take your parent property, plant, and equipment, which is 25,500 plus 13.9 million. So that's 13,900. You do remember we had a fair value adjustment over there, which was here 1,200 negative, but then you have to increase it up by 50,000. Okay. Yeah. So this will give me a total valuation of 38250. Basically, what I've done over here is I've accounted for my fair value adjustments. Now, as far as these investments are concerned over here, okay, so you see the investment which you have done in subsidiary will be replaced by the goodwill. So that goodwill which we calculated after the impairment was 7.8 million. So I'm going to write down that over here, which is 7.8 million. But then you have the other investments also, okay, which were increased by uh, 300,000. So you see from that 1800, 800 was the investment in subsidiary which you have to cancel, but then you did a fair value adjustment for those investments at OCI by 300. So in this case, the balance over there will be 1300. So this gives me a total non-current assets worth of, um, you can add them. Let's keep it for later once we have done the current assets also. So now we have your current assets in which we have the inventory, okay? We have your receivables and we have the bank balance, right? So now I think it's time for you to look up at this adjustment, which is Premier had a trade payable balance owing to Sanford of 350,000. So basically, Premier is saying that we owe to the subsidiary 350,000, but this did not agree with the corresponding receivable in the Sanford's book. Sanford is saying that there is a difference of 130,000 payment made to Sanford, which Sanford has not yet recorded. So basically, Sanford is believing that uh, the parent company owes not only 350 but 480. Why is that 130,000 difference coming up? Because the parent has sent a check towards the subsidiary. So they have removed the liability from their books, but the subsidiary has not removed that receivable from that book because they haven't yet got the money, right? So I'll just write down over here to make it further clear. Okay, we can do it over here. Fine. So you see over here, as far as the Premier is saying, Premier believes that we have to pay 350K to subsidiary. Okay. And the subsidiary says, which is Sanford, that it's 480. How did I got 480? That's all conceptual over here. Okay. So that's receivable from parent. Now, why it says 480? Because this did not agree with the corresponding receivable in Sanford book due to a 130K. So I've added this 130 with 350 and hence I got 480. Payment made to Sanford, which the subsidiary had not yet recorded or received. So basically, the point is that subsidiary is still expecting 480K from the parent, but the parent says it's 350. The difference is of 130, which the parent has already paid to the subsidiary, but the subsidiary would have not received the check, and therefore it's not um, you know uh, recording it in its financial individual financial statement. So when you have to adjust them, the entry would be, see, there won't be any payable and receivable between the parent and the subsidiary, right? So though subsidiary is saying that we have to receive 480 from the parent, you have to remove that, so it's going to be credit receivable. Okay, credit receivable with the amount of 480. The parent is saying that we need to pay subsidiary 350, so the liability will remove on the debit side. So you also have to remove the payable by 350. But the point is of what that 130. That 130 payment which the parent has reduced has actually not left the group, it's within the group. So we need to adjust it back. So what we're going to do is that we're going to debit the bank with the amount of 130. So any payment which is leaving the group should have been recorded, but the parent has recorded a payment which is still within the group. So you don't have to do that. You have to adjust it back. Okay. So that's the difference of 130 over there. So you need to increase the bank balance by 130. You need to reduce the payable by 350, and you will also reduce your receivable by 480. So when you're making the current assets, okay, now for inventory, I mean, there is no problem. You just simply have to add up for both of them, which is 5300, 5.3 million plus 500. But then there was an unrealized profit, and that unrealized profit was here 400. Okay, so the unrealized profit is an overstatement of your inventory, so you need to remove that from the value of the inventory, and that will become 54 or 5.4 million. As far as the receivable is concerned, it's going to be 4200 plus 1.1 million. And then, as I told you in this entry, you have to reduce your receivable by 480. So you will credit it by 480 because that's what the subsidiary is believing that we will receive from the parent. So we don't need to record that anymore because we are as a group. Now, as far as your bank is concerned, it's going to be 3 million plus 800K. But then the bank balances have to be increased by 130 because the parent has removed that balance from their accounts, but actually the cash is not leaving the group. So you have to add it back by 130. So that gives me a total of 3930 for the bank balance, right? So if I total now, my total asset would be 38250 plus 7.8 million plus 1.3 million plus 5.4 million plus receivable and then plus the bank. So this gives me my total assets at 61.5 million. Okay. After total assets, you need to work out on your equity and liabilities, right? So we have the equity shares first. And obviously, we will only write down the parent's share capital over here. But then you also remember that the parent has issued the shares and those shares would have not been recorded, right? So the current balance right now is 12 million. But you know that we acquired 80 percentage of that 5 million shares. So that's like 4 million shares. And on every five, I believe we gave three of them, right? So 5 into 3. So the number of shares what we have issued was 2400, I believe. Okay. Yeah. So those 2400, I'll just verify it. 2400 into 5 was at a valuation of 12 million. Yeah, correct. So the number of shares what we have issued is 2400, but then there has been a premium of $4 because $1 is the nominal value, so that will be reflected in the share capital. But then you have your other equity reserve, which you can use it for the premium. Okay. So here the other equity reserve we already calculated over here, which was 800 so far. But then you also have to increase it by the number of shares into the premium. So which is 2400 number of shares issued, multiply by the premium, which is 4. So this gives me a total of 10.4 million in that case. For the retained earnings, it's quite simple. We just have to bring the figure down from working number 5, which was 11,860, 11.86 million, right? We don't have any kind of non-current liability. So the only liability what we have is your current liabilities. That's it. So current liabilities are 15 million for the parent, 6.8 million for the subsidiary. But then there was an intra-group payable of 350, which we need to remove. Okay. So once you remove it, the net balance for the current liabilities is 21450. And now if we total, so we do expect to get it at 61500. But yeah, the thing which I skipped, sorry, was the NCI figure, right? So in this case, once you have completed the retained earnings, okay, you just have to bring it up your NCI over here. Non-controlling interest, we have already calculated the figure for that. So NCI was 3390. So we just have to bring that figure down over here again. So now if I look up at my total equity and liabilities, right? So in this case, you get this 14.4 million plus 10.4 million plus 11.86 million plus the NCI and then plus the current liabilities. So this turns out to be 61.5 million exactly, and our balance sheet is tied. Now, just a quick advice over here. Let's see, this was like a live recording what I'm doing right now. By mistake, I forgot the value of NCI. So once if I do the reconciliation, I will get a difference of 3390. So if I would have been in your place and if that thing would have happened with me in the exam, I would have just simply looked up at the figures close by 3390 that which I have skipped out. So this will give you an it will save you, like you don't need to worry about in case if you have forgotten a figure or something. The workings are there, the markers do mark you based on the workings what you have done, okay? So you don't need to worry about if you have forgotten a figure or something like that. It's purely fine, okay? The workings are there, the marker do understand like that you have actually shown your concept over there. So in that case it would be perfectly all right. Okay. Thank you very much. If you have any question, please leave a comment and I'll be more than happy to assist you. Thank you very much. Do like and subscribe.